Hello traders, this is John Kicklighter, Chief Strategist for dailyfx.com, here with a Forex strategy video in which we're going to cover a topic that is very fundamental to FX trading, but it is encompassing of many different individual aspects. Now, a very common question or set of questions that I get is, how do we trade risk trends? When do we look for those high yield currencies? When is it better to go to the safe havens? Why do you keep referencing interest rate expectations? And also, how do we measure those things? Those are a common set of questions. I get them at least once a day, the entire set. And it really is a reflection on one of two major aspects of the market, and both actually, risk trends and interest rates. All right. Fundamental, not just the FX market, but all capital markets. Now we can see this in terms of a consideration of an individual currency pair, like Aussie USD. We had a big rally up on the Aussie USD back to this 50% retracement of the April to August bear wave. We hit a also 200-day moving average, and a lot of people were considering at that point, is this a point of continuation or is this a reversal? Well, we have seen a reversal, but at that time, it wasn't as clear. Now we can talk about the catalysts that are coming up, Aussie event risk, US event risk. We can talk about the technicals, which we should absolutely incorporate. We should incorporate all of it. But when we're assessing the situation from a fundamental bearing, we should absolutely consider the most fundamental of these aspects. All right, and that has to be run through an assessment of whether it's time to be risk on or risk off, whether we should be going for a carry trade or not, how interest rate expectations are shaping the expectations of the Aussie USD's outlook for the entire market. All right, this is something that we can apply not just to the Aussie USD. It's a very obvious pair, as would any kind of high-yield currency pair like a Kiwi USD, Kiwi Japanese yen, or a Kiwi USD, New Zealand dollar US dollar pair. All right, this one is much more interesting for its interest rate perspectives, which it's expected to face very high yield increases in the coming 12 months. All right, we could also apply this, however, to benchmarks like the Euro USD. And we can even apply it to individual currencies like the dollar index itself. All right. We have to take this in a certain perspective, however. We have to look at this from the more rudimentary, fundamental perspective. First, what are we doing? We are looking at risk trends. We are looking at carry trade. We are looking at interest rates and interest rate expectations to establish if a currency and currency pair is under or overvalued, and whether it will continue in its given bearing. All right. Now, two ways we need to look at this. We need to do this. There's two aspects to this approach. One, we need to establish the market's balance of risk appetite. Risk off, risk on. Is there an appetite for yield, or is there more of a concern of volatility and the fear therein? All right. That's the first step. The second step is then to find undervalued currencies, given that scenario. And whether we're talking about undervalued or overvalued very much depends on step number one. All right, so let's take this step by step. The first step we're going to take is to first establish the market's balance of risk appetite trends. Now we have a range or a spectrum of safety to risky. All right. Now, risk is only an assumption from more of a pessimistic view, not necessarily pessimistic, but risk is a risky view. All right. At the same time, risk is not just risky; it also provides a significant return to compensate for those risks. Safe havens, which face very little risk, are low yielding, and we call them funding currencies in the carry trade. Spotting a currency or an asset on this spectrum is important because when you're making an FX pair, you want to find a pair that does have an exposure to those risk themes, and you want to set up a high-yielding currency versus a low-yielding currency or a safe haven to garner a stronger reaction, a stronger sensitivity to those themes. If, on the other hand, I chose something like an Aussie Kiwi or a dollar yen, those pairs are not going to be as sensitive to the risk establishment. However, we can still see that removing that risk theme by selecting a pair that's closer on the spectrum and removes that risk element can actually still give us a pretty straightforward trade. We just don't have to look at the risk element as closely. We can look at the other aspects, which will take us into interest rate expectations. All right, so that tells us where we are on the spectrum. But how do I usually establish risk trends? Well, there's actually very complicated, and there's a very easy way to do it. The complicated way is to look at the presumed reactions and relationships between different asset classes. I like to look at the US dollar, I like to look at the S&P 500, I like to look at global equities, I also like to look at particular commodities that reflect sentiment very well and the need for a safe haven, gold being a very good one. All right, but the easy way of doing this is actually, at this point in time, just looking at the S&P 500 or U.S. equities. Why? Because not only is this a reflection of most investors' sentiment, it is also a measure of faith or conviction in stimulus. And stimulus has been a very big secondary provider for an otherwise absent fundamental backdrop. Right? And it has kept capital markets rising. It has kept investors putting their money into the markets. Right, so the S&P 500 can be my measure. As you can see here, risk trends are still relatively robust, though there is reason to doubt that its underlying strength. If you look at some of those relationships for those different asset classes, like global equities are not as prolific in their support for the rise, and definitely from the FX market, we are not seeing the same level of certitude and appetite for yield. So risk trends, risk balance, is one aspect of trading the carry trade or trading interest rate expectations when we fold that in. But the second element is to find undervalued currencies. Now, first we have to establish, do we have a market that is risk on, or one that's seeking yield and is less concerned of volatility and the fear therein, or we are talking about risk off, right, where people avoid yield, that's not their concern. Their concern is to actually find safety, right? If we are looking at a risk on, we want to find undervalued carry currencies. All right, so we want to find undervalued high yield currencies to go long, and we want to short safe havens. All right, overvalued safe havens. Risk off, you want to go long undervalued safe